Secure Act and the environment in which we're planning for our retirement, for taxation, and for estates. My name is Dennis Morton. I'm here with Nick Nanovic and Mike Stout. And this afternoon, what we'd like to do is talk with you about the environment that we are investing in and planning for, but also some of the new developments that we've had with such a volatile year in 2020 so far, and how we want to think about the plans that you're going to put in place for your family as you try to leave a legacy and also navigate the good decisions that your family can make about your finances. So to start out by way of introduction, I'm Dennis Morton. I'm the co-founder and principal of Morton Brown Family Wealth in Allentown. We're an independent fiduciary wealth management firm, and we specialize in individuals and families at all aspects of wealth planning and investing. So I'm a certified financial planner and chartered financial consultant with expertise in retirement planning, investments, taxation, estate planning, and insurance. Nick Nanovic is a partner at Gross McGinley in Allentown. Nick partners with his clients designing comprehensive and customized estate plans for families, as well as navigating complex tax matters. He strives to understand the goals of his clients, utilizing various types of trusts to ensure assets are protected for future generations. Nick is an accredited estate planner and holds his LLM in taxation. As the chair of wills, trusts, and estates for Gross McGinley, he leads a team of attorneys, paralegals, and staff in improving quality and efficiencies with regard to estate planning and estate administration. Mike Stout is a certified public accountant with nearly 25 years of experience in public accounting. After starting his career and gaining valuable knowledge at one of the Big Four accounting firms, his love of the area drove Mike to build his practice, Stout Associates, in the Lehigh Valley. He is experienced in providing tax advice to families with complex financial holdings and maintains a passion for helping small and family-owned businesses excel. So today what we're going to do is each take turns going through different aspects of the Secure Act and what the implications are for you. There's a means of adding in some questions on the right-hand side of your screen. So as you have things, we can take them as we go. So feel free to raise your hand and jot in a question, and we can answer it as we go along. We'll also leave some time at the end. And as I said, we'll give you an update on some current conditions and things we're thinking about as some of the legislative changes are coming down the line through Congress as we speak. So to start, here's an introduction to the Secure Act, which is actually an acronym, Setting Every Community Up for Retirement Enhancement. It took effect on January 1st of 2020, and the idea behind the act was to ease restrictions that have kept employees and savers from accumulating a nest egg in a retirement account. So we're talking about everything from early career participants to people later on in their careers who still need to save. The whole idea of the act was to create incentives and the structures so that people can save more of their assets for retirement. Some of the changes affect employers and their ability to create structures for saving, but other changes affect you and I as we think about distributing our retirement assets as we age or during the course of our careers. So that being said, I'll turn it over to Mike Stout to get us started. Mike?
Thank you, Dennis. So basic criteria or changes to the law in fact impact the individual investor and retirement investor specifically. And one of the big benefits is that because people are living longer, the Treasury Department increased the minimum required age for when you have to take out your minimum required distribution. So from 70 and a half years old to 72 years old. So it's a year and a half longer that the assets can sit inside of your IRA without having to distribute those funds. The Act also repeals the maximum age for IRA contributions. Currently, the age was maxed at 70 and a half years old. As long as you have earned income, you can continue to to make contributions now to your IRA. One of the downsides, and Nick will be speaking to this and addressing some strategies behind this, but one of the downsides to the Act is that it eliminated the stretch component of inherited IRAs. So if a 40-year-old inherited an IRA, she could stretch out the distributions over the actuarially determined lifespan. Now an inherited IRA must be completely emptied out within 10 years. So it eliminates that stretch. And again, Nick is going to talk about that a little bit later. It also allows some more flexibility. If we're trying to encourage people to contribute more money to qualified plans, one of the fears always is that life happens. They want to buy a house, they want to have a child, they want to do X, Y, and Z. And of course, there's penalties associated with early withdrawals. So this removed penalties for withdrawing up to $5,000 from a qualified plan for new births and adoptions. There's also some benefits for stretching out the tax implication on that component as well. The other impact, or one of the other impacts to the law, affected 529s. And basically what this allowed is a little more flexibility in using the 529s. Again, some folks are concerned about overfunding a 529 because the distribution has to be used solely for educational purposes. And if you're running out of children and you have more money in your 529, it could be a little bit of a concern and people were not funding their plan. So in order to encourage people to fund, they added another component. Actually, they added a couple components recently. But one of the newest components is that you can take a qualified distribution from a 529 to pay your student loans. You can also use a 529 plan distribution to pay for apprenticeship programs. Both of those are newly qualified uses for 529s. Now, one of the kickers is if you use the 529 to pay your student loan, then you can't take the student loan deduction on your tax return. So there is some analysis that needs to be done as to which is better. But if you're going to lose the 529 plans, you might as well use the funds accordingly. Again, because life happens, and interestingly enough, with what's going on with the virus, I would not be surprised if COVID-19 qualifies for disaster distributions. But this allows for taking out distributions because of a disaster and spreading out the taxes over 3 years, avoiding the penalty. And there are some lifetime caps and things like that. You're also able to repay the portion of the distribution over 3 years as well. So this may be necessary for some people that are going without income during this time period. They may be able to take out a penalty-free distribution from their IRA if this is qualified for that. And I would have a feeling that it would be. There are some changes to the way that retirement plans can be handled by small businesses. The Act basically is making it easier and more affordable for small businesses to implement a 401k plan for their employees. One of the things that I'll talk about that a little bit later, but one of the things that it also does is that it requires that long-term part-time employees be eligible to participate in the 401k plan beginning in 2021. Now, their participation is in their own elective deferral of their compensation. It does not require the employer to match a long-term part-time employee if he or she does not meet the current matching requirements, but it does require the employer to permit the employee to participate in the plan. So again, this enables people to perhaps contribute more pre-tax and save more money towards retirement. As I was alluding at the beginning of the second slide, small businesses are now allowed to form a consortium and to sponsor a 401k plan. So it's called a multiple employer plan. So if you're a small business owner and you find the administrative costs or the compliance costs too onerous to implement a plan, you can now become part of a multiple employer plan. And along with that, the administrator is allowed to file the Form 5500, which is an information form filed with the IRS every year. It also requires, and this is very interesting because there's no real guidance at all, it also requires that employers are going to have to start telling their employees how much money they're going to receive when they retire. Now, there's a whole bunch of caveats around that, and the Treasury Department hasn't issued guidelines, but they're basically going to make employers and plan administrators assume that the money is, for all intents and purposes, rolled into a fixed income vehicle earning 4%, 5%, whatever the number is, and taken out in a pro rata manner over the lifetime of the participant. And I think the idea here is that, one, it's giving them a little bit more information, but it also may be scaring them into realizing that they're not saving as much money as they should be. So that's one of the requirements that's being placed on the plan sponsors. For those that want to start up, for those small businesses that want to start up a new retirement plan, there are some tax credits. The startup costs are not astronomical, and the tax credits would easily cover those costs. In my experience, my small business clients aren't usually afraid of the administrative costs for starting up the plan. They're often more concerned about being stuck with an employer match in a year when they can't afford it. But this would help alleviate any startup costs. It also encourages small businesses to adopt an automatic enrollment for new employees. So what that means is that when you're onboarding a new employee, the default position would be that the employee is enrolled in the 401k plan at a specific payroll withholding amount, 5%, 6%, whatever the amount is. The onboarded employee, the new employee, can opt out of this, but the default position would be that she or he are enrolled in the plan. The idea is that in the automatic enrollment process, there's a greater likelihood of increased participation because it's harder to opt out of something than it is to just go with the flow during the enrollment process or the onboarding process. I think at this point, we're going to turn it over to Nick, who's going to talk about one of the challenges to the Secure Act and some possible solutions as to how to address this. Nick?
Thanks, Mike. So as Mike alluded to earlier on the presentation, one of the provisions of the Secure Act is the removal of the stretch IRA strategy. This is going to be a change in the law that the government's estimating is going to earn them an extra $16 billion of revenue over the next 10 years. So this is not an insignificant change. And so I'll walk you through what this change is, what it means, and illustrate how it may impact you, may impact people you know, your clients, and specifically how it could impact people's estate plans. So what the old rule was before the Secure Act with the stretch IRA, and to clarify, when I mention IRAs, this also applies to 401ks and 403b plans, any type of qualified retirement funds. Under the prior laws, when a beneficiary inherited these qualified funds from someone, they would be able to stretch out the distributions over the remainder of their lifetime based on an actuarial table that the government publishes. And I'll go through an illustration of what that looked like under the old law. Under the new law, that is minimized now to a 10-year period. So for the most part, it doesn't matter how old the beneficiary is. After the original owner of the retirement plan dies, the beneficiary has 10 years to pull all of that money out of the retirement fund. There are a few exceptions. Surviving spouses are still able to roll over their deceased spouse's retirement plans into their own retirement plans. So in that situation, there's not a 10-year stretch out. They're still allowed to roll it into their own and take minimum distributions based on their own lifetime going forward. If there is a minor child of the IRA owner, that minor child can stretch out the distributions for a period of time beyond 10 years. The way that's going to work is that the RMD schedule will be applied up until the point of time where the minor child reaches the age of majority, which is going to be judged state by state. In Pennsylvania, that's going to be 21. And then after the age of 21, for a Pennsylvania minor, the 10-year period begins then. Similarly, the 10-year period isn't going to apply to beneficiaries who are considered disabled persons or chronically ill persons, or for beneficiaries who are 10 years or less younger in age than the original IRA owner. So there are a couple exceptions there, but they're unique situations. There's not much planning to be done there. It's just more of a fact to be aware of when analyzing these situations. For the next few seconds here, I'm just going to go through the tax rate schedules because that's going to have a big impact on how these distributions are evaluated when beneficiaries take them now under this new rule. So we have here the personal income tax rate schedule, 2020 on the right-hand side. The reason I have 2017 on the left-hand side there is because back at the end of 2017, there was a new tax law passed, the Tax Cuts and Jobs Act, that changed the structure of tax rates. You can see in 2017, the last year of the old rate structure, the highest tax rate was 39.6%. After 2017, the rate structure changed to what it is today, where the highest rate is 37%. The reason I'm showing you 2017 is that under that law, the TCJA, we're scheduled to go back to this old rate schedule after 2025. So for the next 5 or 6 years, we'll have this more condensed rate schedule. But after 5 more years, 5.5 more years pass, starting in 2026, we're going to go back to this other schedule that is going to create higher taxes if Congress doesn't act and make this permanent or make any other changes. And I'm going to show you an illustration in a minute here on how that works from a tax standpoint. Key number to look at on the married filing jointly rates, right here, the 24% rate versus the 28% rate. I'm going to use an example of a married couple who, before any IRA distributions, has $200,000 of taxable income from wages, rental income, any other sources. And just looking at these two schedules, you can see on the right-hand side under current rates, that $200,000 is going to be taxed at a rate of 24%, and there's a cushion there of another $126,000 some that will still be taxed at that rate of 24%. Under the rate schedule that's scheduled to go back into place in 2026, those funds are going to be taxed at a rate of 28%. And once you hit the $233,350 mark, anything above that will be taxed at 33%. So there's going to be a substantial tax burden if these older rates come back in the year 2026. Also here, the married filing separate rates. So I put all the schedules here. So depending on what category you fall in, you can look at these schedules and see where you may be. So going towards an example here, let's pretend that we have an IRA owner who passed away when the IRA was worth $1 million, and say that there was only one beneficiary, a child who was 55 years old at the time. Hypothetically, this beneficiary is a married person, files a joint return reflecting $200,000 of income before any of these IRA distributions. Now, under the old rules, that beneficiary, that sole child, would be able to stretch out the distributions over his remaining lifetime based on the actuarial table for someone who's 55 years old. So let's assume the IRA assets don't change in value, just to keep the math simple here, and that the beneficiary received only that minimum distribution amount for the next 10 years. Under the old rules, what would happen there is that the amount actually received out of the retirement fund would be a shade over $337,000, and the income tax impact would be an $81,000 bill over that 10-year period. The remaining $662,000 would remain in that IRA, and the beneficiary would have to take out minimum distributions for the rest of his lifetime. Under these new rules now, that entire $1 million plan must be liquidated within 10 years. So the result of that is going to be an income tax bill of $240,000 over that same time frame. So basically the tax bill triples because of this new law under that hypothetical. I want to go over how that's going to have an impact on estate planning, and also talk very briefly if there's any planning techniques to minimize these income tax consequences. So starting with estate planning, the biggest area this is going to impact is people who use trust in their estate plans. Trusts are always usually a good tool to implement for asset protection purposes primarily, and for a lot of people, they would have their retirement plans also run through these trusts to add that layer of asset protection. And under the old laws, the common technique would be simply to include provisions in the trust agreement so it was considered a conduit trust. What a conduit trust is, it basically means that the trustee of the trust would take out the distribution from the IRA, put it into the trust account, and within that same tax year, push it out of the trust account into the beneficiary's name. There's tax reasons for this, and I'll get to that in a second. The other type of trust that could be involved is an accumulation trust, which would be the exact opposite. The trustee would pull out the distribution for the retirement plan, but that distribution, instead of being pushed out immediately to the beneficiary of that trust, that would instead be retained inside that trust for a longer period of time. So why does that matter from a tax perspective? It comes down to the rates at which trusts pay taxes. So this is the tax rate schedule, again, 2017 compared to now 2020, of how trusts are taxed. And again, if we're talking about $100,000 coming out of a trust, coming out of a retirement plan into a trust, you can see that if the trust retains that money in an accumulation trust, the majority of that distribution every single year is going to be taxed at a rate of 37% instead of 24%, which is the tax rate for a married filing jointly taxpayer who may have $200,000 of income already. So there's going to be a huge jump in income taxes for that reason if the trust retains the income. So what many people are going to be faced with now is going to be a challenge. What is more important for these retirement funds? Is it more important to minimize the tax consequences and use a conduit trust and make sure that all these retirement funds are pushed into the beneficiary's personal accounts, but knowing that it has to happen within 10 years now? Or is it going to be more important that those funds are protected for the beneficiary's interest for whatever reason it may be? The beneficiary is financially immature, has creditor issues, whatever it is it better to protect it with the trade-off being there's going to be a much higher income tax bill to be paid? So there's not going to be a right or wrong answer, but it's going to require a more thorough discussion with people about what is more important to them. And just to illustrate how those higher tax rates would work for an accumulation trust versus a conduit trust, again, assume the same fact scenario here, but that instead of the distribution going directly to the sole child, it goes into a trust for the benefit of that child. Under the conduit trust situation, the beneficiary's tax bill is again going to be $24,000, with everything coming out over 10 years and being pushed out to the beneficiary, taxed on that beneficiary's personal income tax return. If this is an accumulation trust, that same amount of amounts, $100,000 per year, is going to result in an annual tax bill of $35,338. So you're basically, in this scenario at least, hypothetically, you're increasing your tax bill by almost 50% to provide a layer of asset protection for those assets. Again, depending on the situation, that may be a worthwhile cost. For other people, that may be too high of a cost. But the numbers are going to have to be run and analyzed for people to really know what's the best choice for their situation, for their family. And as far as minimizing the income tax hit, there's really not much available. You can choose beneficiaries who will still be allowed to stretch out the IRA. We reviewed that at the beginning, such as minor children, disabled people, chronic people. But again, is that the right choice? Someone's not going to choose those people just for the sole purpose of minimizing the income tax consequences. So to me, that's not really a plan. Naming multiple beneficiaries may be an option, again, depending on the family dynamic or the individuals involved. So for example, if you have an IRA owner who has 2 kids, and each of those 2 kids have 2 kids, so a total of 4 grandchildren, instead of leaving the IRA 50-50 to 2 kids, maybe you split it up into 1/6. So there's less income to go on a single person's income tax return, and the grandchildren will be receiving some of that income immediately also. Again, there could be reasons not to give the grandchildren a large amount of money at whatever age they may be. So it's going to require an analysis to see the best fit. And finally, one technique I've seen marketed, discussed a lot since this new law came out, is the use of a charitable remainder trust. And the benefit there is basically if you have a charitable remainder trust, which has very specific, strict guidelines that must be implemented to qualify under the IRS's definition. If the retirement plan gets paid to the charitable remainder trust, that trust is not going to pay income taxes on those qualified funds that it takes in. And the way the trust would work then is that you can have individuals be the beneficiaries during their lifetime, and then there would have to be a qualified charity to receive the remaining funds after the lives of those beneficiaries end. There's a lot of complications with this. First, there's a lot of actuarial calculations. The charitable remainder trust has to be actuarially sound. Part of what that means is that when you run the calculations, there must be a certain risk level there that assures a charity that at least 10% of the initial deposit will be turned over to charity when the individual beneficiaries pass away. There's also a risk there that if the named beneficiaries, the individuals, should suffer a sudden death, an unexpected death, these funds then don't get transferred to the next generation or the generation after that. There has to be a finite time when these funds are no longer available to individuals and must be turned over to charities. So unless the IRA owner has an actual charitable intent, a charitable purpose, using a charitable remainder trust for the sole purpose of minimizing income taxes may not be the best tool to use. But again, it's an option out there that needs to be discussed and analyzed to see in what plan it may be the best fit. And so with that, I will turn it over to Dennis to talk about more of the strategies and tools as it applies to retirement planning.
Appreciate it. So when it comes to retirement planning, a lot of the decisions that we make have to do with a balance of assets and a balance of income, which are unique for each one of us. So as I talk through some of these, I want you to imagine the situation that you could find yourself in where 2 different people could have $1 million saved up in assets for retirement. But the person who has $1 million all in their IRA or 401k is making some different decisions than someone who has maybe $500,000 in a taxable investment account or joint investment account with their spouse and $500,000 in an IRA. There's different sources to draw upon, and some of the changes and rules from the Secure Act mean that you have to rethink the math that goes into this. So let's start by revisiting the required minimum distributions conversation. and what that delay means for someone who's planning their income in retirement. First of all, it allows for longer tax-deferred growth. So for many people who were early adopters of 401ks, who've built up a nice nest egg, it allows them to keep that nest egg intact and growing for a longer period of time. But even overlaying a time like right now, extending that out means that someone does not have to take their money out of the market, pay the taxes on it at a time when the markets are down necessarily, which is always one of the risks, is taking your money out, paying taxes, and then not having the full asset there to be growing. So it defers that a little bit. It also means that it changes the Social Security conversation. So for many people, they're reaching their maximum Social Security age around 66, or their peak retirement benefit, and then they'll extend out to age 70. Now we have it until age 72. So what assets are you drawing upon, ideally, to meet your income need? Starting in your 60s, you might be taking Social Security, you might be drawing down your taxable investment account and delaying on your IRA or 401k for as long as possible. Well, with that being pushed out, we need to think through, does it still make sense to choose Social Security at a particular age? Does it make sense to spend down your taxable investments before you get to your IRA? The second piece for retirement planning is that there's no longer a maximum age for making contributions. So this is one of the areas where it's been interesting to see how public policy and legislation has started to take into account financial behaviors and how to really nudge those behaviors in the right way. We saw this a few years ago in retirement plans when they started using target date funds. For those of you who've been participants in 401k plans, know that target date funds are the default option now for when you make a contribution. And the reason that was done is because people would make a contribution to their 401k plan. It would sit in cash, wouldn't grow unless they actually made the proactive step of investing it. And now they're not growing as they need to develop their retirement nest egg. When they changed over to target date funds, that's one less obstacle to help people grow and save for the long term. This is another aspect where we're recognizing the reality of retirement for people, which is they're living longer and their expenses are higher at the end of life than we might have anticipated just a few years ago. So because people are working longer, living longer, allowing them to contribute beyond the age of 70 and a half makes a lot of sense, because we want to make sure that those people, to the extent they're going to live into their late 80s and 90s, they're going to have those nest eggs develop. So there's a lot of behavioral nudging that's happening from a legislative perspective to stack the deck in the favor of retirement savers. So this applies to people who are earlier career planning. Again, some behavioral nudges. Why might someone not start saving? We'll start with the withdrawals here first of all. Someone might not start saving into their employer-sponsored plan or their IRA or Roth IRA because they would be worried that if we had an emergency expense, like we had a baby and we needed those expenses, want to start a family, we've put that money in a place where we can't access it. Well, now there's going to be withdrawals allowed of up to $5,000 from 401k accounts to subsidize the birth of a child or adoption. There are no penalties and it can be paid back. So it's one less hurdle to get that process started of saving. Second, the repayment of student loans. That can be allowed up to $10,000 from 529 plans. And this is, as Mike said earlier, it's that imprecision. I have 4 kids, their college situations might be vastly different, but I always think about what is the risk of overfunding. Now I can move those 529 plans between the different beneficiaries to try and cross-level them. But by the time my 3-year-old gets to college, if I've overfunded in one place and underfunded in another, it gives me a little bit more wiggle room to right-size those, and maybe gives me the incentive to use that vehicle a little bit better. So, investment planning. This is where we think about the right asset in the right place for the right purpose. And the elimination of the stretch IRA, it changes how we think about the use of qualified assets like IRAs and 401ks. So as we said, if you're opting to delay Social Security as long as possible out to age 70, then you might be drawing down another asset. Ideally, that's something that's not in your IRA. Maybe you saved up in a non-qualified investment, and spending that down in your 60s, then turning on your Social Security income stream, and then using your required distributions from your IRA might have been the plan up until now. But now if you're projecting out and saying, well, my IRA then becomes a very large asset that my heirs inherit, maybe that's not the best thing for me to leave till last. So we're already starting to work through plans with clients where we look and say, does it make sense to front load the spending of the IRA in your 60s, post-retirement, in your 60s and early 70s, when your tax rate might be lower than that of your children, where you're going to be spending at a certain level, you have a predictable stream of income that you need, and then leaving your taxable investments for later on in retirement. So maybe you're spending down your IRA more than you were going to before, but you have a larger pool of non-IRA assets that you could use for things like maybe funding long-term care or higher health expenses at the end of life. It just changes the math a little bit because, again, if you're trying to limit the tax burden or make for a more efficient transfer of your assets that you have, that's something to talk with your advisor about and how to balance those things depending on your situation. So that's really, between your tax advisor, your attorney, and your accountant, it's that sequence of spending. And there's no precise target because something could happen tomorrow to any one of us that would change the equation for your family. But it's really trying to build in a lot of flexibility to say, let's pull from this lever at this time to be as tax efficient as possible. And this is just coming back to that taxable account. If you do have assets outside of IRAs that you're managing, that you're growing and trying to make sure that there's a balance between those two, late in life, if you're looking at, again, this person who has $500,000 in an IRA and $500,000 in a non-IRA investment account, it's more tax efficient to pay large bills from your non-IRA, from your taxable account. Because every time, if you're trying to take $100,000 out of your IRA, as Nick illustrated earlier, the tax consequences can be pretty substantial. So if we're trying to self-fund, IRAs can be a very inefficient way to pay large bills. So if we can preserve your non-IRAs out longer to late end of life, then that becomes a much better tool. The last thing to consider is a Roth IRA conversion. So what happens with the Roth IRA is advantageous because you contribute to it on an after-tax basis. The assets grow tax deferred just like they would in a 401k or an IRA. But at the end of in retirement, there's no obligation to take required minimum distribution. Now, for many people, they're limited in their ability to contribute because there are contribution limits for a Roth IRA, and not everyone has a Roth 401k option. But if you have a large IRA, if you have an IRA of any size, really, and are trying to think of ways where you can front load the taxes, maybe take some of the tax burden off of your heirs, you can convert IRAs over to Roth IRAs, and usually it's done in pieces, but to roll over that amount and pay the taxes currently as ordinary income, and then that asset becomes a much more efficient one to pass on to your heirs, and you front loaded those. Ideally, what you want to have is the ability to pay the taxes on the conversion from assets outside of the IRA. So if you convert, $50,000 from a IRA to a Roth IRA, you want to account for those taxes somewhere else so that you don't have to deplete the impact of that on your investment account. So historically, we've usually looked for that in low tax burden years. So after retirement, and maybe there's some opportunistic times based on your tax situation. But I think this is going to become more of a conversation as parents think of ways to, is it more efficient for them to pay the taxes on IRAs and then pass it on to their heirs without having to take required minimum distribution? All right. Now want to move on to this market update, which is so timely that we don't even know what some of the details are, except for what's been leaked out in certain forums a little bit to discuss policy responses, what's happening in the form of fiscal stimulus that could create unique opportunities. So a lot of what we're hearing right now from the bill that's being worked through the Senate and then presumably the House very quickly is that there's going to be an emphasis on two things. One is liquidity and the other is flexibility. So you're seeing some initiatives that might impact retirement savers, like being able to take large distributions in 2020 from your 401k plan, up to $100,000 potentially, or being able to take larger loans out of your 401k plan. A lot of this crisis is coming down to who has access to the cash needed to bridge them between now and some period in the future when all of this passes. So that's whether it's a small business or an individual or a retiree, it's really making sure that you have access to funds in the right way. There's even some discussion on whether RMDs are waived for this year, whether that's on the table or not. We have to wait and see the final bill. But the policy responses are really aimed toward keeping adequate liquidity. And a lot of these decisions that we talk about, whether it's how substantially we fund our retirement accounts when we're working, it does really come back to how do we make sure that we have the right access to the right funds at the right time. And I think as we see these things lay out, talk with your advisor about whether some of these things make sense, because some of the decisions we make are irrevocable. Decisions like timing of Social Security for the most part, or taking money out of a 401k or out of an IRA. So make sure you know the rules that are going to govern in 2020, a very extraordinary year, what you can take out and when. It also is interesting to note whether contributions make sense. So for some people, we might say, if you feel like you're light on cash and your job insecurity, or there are things that you might that might have to flex for you in the short term, maybe suspending retirement contributions or suspending some 529 plan contributions. Maybe if you're making extra payments on your mortgage, maybe keeping that as dry powder here for a little bit might make sense, knowing that you can catch up later on and make up the difference. For other people who might be saying, I was planning on increasing my retirement plan contributions, with the markets being much lower than they were, this might be a good time to increase those. But just knowing if you're putting them in a place where you can't get them, what are you giving up on the liquidity side? So we always talk about owning the right kinds of assets in the right accounts. Make sure that your cash is cash and is doing its thing by being very stable, and you have your growth and your risk and your volatility did elsewhere. Last piece is the impact of lower interest rates. And this was the challenge for the better part of the last decade. We started to come out of it a few years ago, but we're back to a place where our safe money is earning next to zero. When our safe money earns next to zero, it changes how we think. It makes us be a little bit more precise about where we're invested and how, and whether you need to earn tax-free income, whether you need to earn income inside your tax-exempt account, and how much dividends play into things. So I think, and this is a moving target because it just happened in the last few weeks, but with interest rates being back to zero, it changes the math on how we derive income and where it's going to come from and which account. So I think it's an open-ended question, but I think over the next couple of months, we're going to be talking with our clients, and I'm sure talking with a lot of other advisors about how our strategy for earning income in retirement changes with interest rates being back to next to zero. So I'm going to open back up. And Mike, why don't I start with you? What are some of your observations on potential changes or things we've already seen announced as policy changes on the related to coronavirus?
Yeah, so obviously one of the things that just selfishly impacts tax accountants is, and I guess all taxpayers. So there has been an extension of the tax filing and tax payment deadline from April 15th to July 15th. And more recently, most of the states and all of the localities in Pennsylvania, and Pennsylvania State, have agreed to extend their deadlines to July 15th as well. So basically, for all intents and purposes, July 15th is the new April 15th. And taxpayers do not need to file an extension. They get until July 15th without having to do anything extra. The challenge really is going to be, of course, that none of our software is programmed for all of this. And every return I print off right now says your payment's due April 15th. So tax software programmers are scrambling to get this right. And we have to do some changes to the calculations for penalties and interest and things like that. And a couple of us are pretty concerned that on April 15th or April 16th, if we go to file a return, that the IRS or the software won't permit it because it's past the deadline. But hopefully all of that will be addressed. I think some of the other things that we're seeing is this confusion over what employers are going to be reimbursed for. Right now, it's pretty clear that if you have paid sick leave for employees that are sick or who are taking care of someone sick, there's going to be some tax credits for that. The question is for small businesses that keep employees on payroll but that are shut down. These employees may not be sick, but they're still getting a paycheck. There's not a lot of clarity for that. Some of my clients are hearing that there's tax-free, that there's loans that are going to be forgiven. I have not seen clear guidance on it. Now, again, I've not had a lot of free time to read everything, but I have not seen clear guidance on that. There's pretty clear guidance on paying sick leave and being reimbursed. The other thing today that was announced by Governor Wolf is that there will be a $100,000 max working capital loan program that small businesses under 100 employees can apply for. It's a 1 year, no payment required, 2 years monthly payments for months 13 through 36, but it's on a 10-year amortization and then a balloon payment, and most of it's at 0%. Of course, there's a bunch of guidance and guidelines and forms and applications, but that's actually ready to go. And if anyone needs further information on that, I actually have all the applications and everything, and that was just announced about an hour ago. I'm sure I missed something, so Dennis, if there was something specific you wanted me to address, let me know. But there's a lot out there right now.
There is a lot out there, and I think some of the challenges are going to be figuring out the plumbing, how this all reaches small business, develops the understanding. I mean, the professional advisors, I'm sure, are going to be inundated with information on this, but I think keeping these conversations going and interpreting this is important. Nick, I was thinking about the stretch IRA and what a declining market means also for people who have to take distributions out at a time when the market might be low, and you have these big lump sums. Then you defer to another year to try and avoid taking money out, and you have a larger tax bill the next year. Any thoughts from you on what changes here from whether you're thinking about stretch or estate planning?
Yeah, as far as the stretch IRA, it just whether the market's up or down, it looks like it rebounded nicely after yesterday also. It's going to be a matter of timing because you have all these moving variables, increasing and decreasing market values, tax rates that could change after 2025, may change before, may change after based on congressional actions. And then individuals' personal income situations. You mentioned, Dennis, usually you look at Roth Conversions. Maybe if you're close to retirement, wait until those retirement years to do that. There could be other income events in people's lives. They have a very good year or a very bad year while they're still in their working years, and that may have an impact on how much tax they pay on the distribution from this IRA. And the one thing I wanted to clarify with that is that the new 10-year rule, it is not like the old RMD rule, required minimum distribution rule, where you have to take out a certain calculated amount each and every one of those 10 years. The beneficiary is going to be able to have the option, if they want, to keep the entire amount in there and pull 100% out in year 10. Or you can pull out a portion in year one, nothing in year 2, some in year 3. There's no requirement for years 1 through 9 how much gets pulled out. The new rule just requires that all of it is in the individual's personal accounts by year 10. So yeah, changing markets is going to be one factor, but there's a lot of other factors there that are just going to have to be evaluated on a year-by-year basis with these new rules.
What about QCDs, qualified charitable distributions? What's the impact on those, or how do those potentially play a role for someone who has philanthropic intent?
So the qualified IRA rollovers, those are still the IRA owner, rather than taking a distribution during a and then donating that money directly to a charity and a deduction on the tax return, the IRA owner can have the distribution or a loan amount from the trustee of the IRA, the brokerage firm, to the charity. And the new Secure Act doesn't change too much of that. It still allows for so the one big change that we have to be careful of is that because the Secure Act now allows contributions after the age of 70 and a half, having no age limitations now as long as there's earned income, there's going to be some clawback provisions so that if people are contributing to IRAs after age 70, after age 72, and then also doing qualified rollovers to charities in those retirement years also, or retirement age years, even though they may still be working, there's going to be a certain offset that's going to have to be calculated. So that's the big change with qualified charitable IRA rollovers with the Secure Act. But for the most part, they're still there, and they're still a very good tool for people to use, because otherwise, if that income hits their tax return first before they donate to a charity, it has several other impacts on taxation of Social Security benefits, I think certain Medicare costs, the choice of whether to itemize deductions or not. So it's still a good tool to use, but people using it just need to be aware that there have been some, I'll call them tweaks more than radical changes.
Mm-hmm. Before we just give our final thoughts here, if you do have any questions, feel free to jot them down in the chat function on the right side of your screen. But one thing just to comment on what's happening from the investment and the economy perspective is, if you're taking time to rethink your financial plan, your estate plan, your tax plan, a helpful way to look at this was brought up yesterday in an article by Jason Zweig, who writes the personal finance column for the Wall Street Journal. And he kind of challenged people to ask themselves, are you yourself a stock or a bond? That if you're feeling like volatility is changing the way you think about your finances, and ask yourself, are you the kind of person who is living on a stream of income from Social Security, from a pension, or has a very secure job, that there's not a lot of risks to that job going away during this hiatus for the economy? Or on the flip side, are you someone who may be a small business owner or works in a volatile industry where your job might be in jeopardy? In which case, you're more like a stock versus someone who has more securities like a bond. And if you think about your investments and your planning that way, someone who themselves is a stock might want to be more conservative in how much cash they keep, how much they keep accessible to them. Their levels of liquidity might need to be a little bit higher. And it's a balance between that asset location. So just, it's an interesting way to think about it. Are you a stock? Are you a bond? And do you plan accordingly around that framework? All right. Mike, any final thoughts?
Other than if anyone needs information about the loan program, they can contact me. And maybe, Dennis, we can send out an update in a week from now to some of the participants as things become clearer.
I think that would be a great idea. Nick?
I'll just echo what I think we're part of the message we're trying to convey throughout our past hour is basically there's a lot of different angles and aspects of these rule changes and law changes. So just the importance of talking to your account advisor and your lawyer, because there could be again, different aspects here that one is more skilled with and may defer to another professional to handle the other aspects. Just to be careful, make sure that you address every angle with the planning.
Great. Thank you both for being here, and thank all of you for joining us today. Hope this information was helpful. And through all this turmoil, if we can be of assistance, we'll send out our contact information so you can reach out directly. But in the meantime, we hope your families are healthy and safe, and wish you all the best during these very interesting times. So thanks again, and we hope to catch up with you soon.